for building an investment strategy in your super, you're in the right space. My name is Will. I'm one of the member education consultants here at CSC, and I'll be running the session today. I'll just, if you get a thumbs up, you can hear me and also see the presentation on my screen. Anyone's listening? Yep, beautiful. All right, I'll take that. Thank you. Okay, so look, this is one of a series that the DHA are putting on. There's I think there was be links for other ones, but ultimately, yeah, this will be looking at investment strategy within superannuation. And the recording, for if you've got any colleagues that haven't been able to make it, the recording will be available later in the week, I believe. Before we go any further, I'd like to begin by acknowledging the traditional custodians of land on which we meet and pay their respects to their elders past and present. And I'll extend that respect to all Aboriginal and Torres Strait Islander people joining us here today. A little bit of housekeeping, or just we'll go through. First of all, on the screen there, we've got our general advice warning. So all this information will be general advice around investment strategies. Without being able to take each and every one's personal circumstance into consideration. Look, there really is no one right way to do things, and sort of factoring in a bunch of different things. We'll cover off those concepts and hopefully also provide you with some other avenues to perhaps seek further information or advice. But today, it will all be general advice. And the target market determination, really today we'll be looking at the PSAP account. So if you're PSAP members, you can find further information on that link around the suitability as a fund for you. And if you are a non-PSAP member, so this general information will be pertinent to other super funds. It's all fairly similar, the strategies and concepts, but we'll just be talking via using examples from our products. If you're a PSS, defined member, this won't necessarily be relevant for you, but unless you do have an ancillary account, but really that's who we designed this for. Look, it is a small group, and I'll monitor, and I really encourage questions. So if you've got any questions, please do ask them and throw your questions into the chat. So we won't be using the Q&A today, but the chat works pretty well. So pop a question into the chat. I'll keep an eye on it best I can, and I'll respond to those as they come through. I'll just actually move it a little bit extra spot on my screen. I'm running off two screens, so I should be able to see that easy now. All right, so look, we'll cover off very quickly who CSC are and where we fit into the piece, but really we administer PSAP, so that's probably the long and the short of it. Really got a quick thing around what super investments is, how it works, and how kind of, I guess, your strategy might change depending on your life stage. So we will be covering off and talking a lot about time horizon, or the amount of time you're investing and the importance that plays in sort of, I guess, forming the basis of a strategy that might be best for you. And then I'll give you a few links and some ideas potentially if you wanted to do after this as next steps. So CSC, we've been around for 100 years. We've been looking after public service and defence funds for that period of time, and one of those funds that is open now is our PSAP, which is the one that I'll make the assumption some of you, or at least all of you, are in. Or all of you, at least some of you might be in. All right, so let's talk really quickly about how super investment works. Right. Let's take again through that. We'll take it back another step. What super is and how it works. Effectively, it's a savings account that's been designed that employers are required to put in contributions every pay. DHA, they're putting in 15.4% super contributions. So 15.4% of your salary is going in. Additionally, is going into this savings account of yours. We know it's got some special conditions. It is primarily designed to provide you with an income in retirement. Now, when and how you retire is totally up to you, but accessing your superannuation may well be part of the decision-making process. And we can all access our superannuation from the age of 60 onwards. 60, there is some conditions of release, one being that you need to have ceased employment at that point. But hopefully we've been contributing, our employers have been contributing. We can make personal contributions, of course, on top of that, either pre-tax or after tax. But ultimately we build up a nice little nest egg that we can then switch on into it as an income stream in retirement. If we think about that, we could be working for 40 years or so. And so just by making those contributions, that's great. Additional contributions can be better. But what do we do with that money in that time? And that's when we're talking about the investments. And so we take that money in CSC on your behalf, invest that, and hopefully getting a higher return on investment, which compounds over that period of time, which helps build that nest egg into a nice, healthy balance that will allow us, hopefully, to retire on our own terms from the age of 60 onwards. Really, so some of the concepts we're going to be talking about is and one of the key things I think around investment strategies, and one of the most important things, particularly when we're talking about superannuation, is divestment. So super, for what we've just talked about, has a really important role to play. If you do want to take the example of retiring at 60, you might live another 30 years on average, which is an extra third of someone's life. So our super plays an important role, and having it in a risky environment where potentially we could lose our money is really important that we don't do that. And so super funds on the whole, particularly big funds like CSC, the other big industry funds, etc., really focus in on the diversification strategy, i.e. not putting all your eggs in one basket. So we look at investing at different types of assets, asset classes, and then within those asset classes, different investments that kind of counter each other and ensure that, if the markets are going up or down, which they will, we're seeing those ups and downs in line with how those markets are reacting, not putting all our eggs in one basket, investing in a single investment that could potentially have a really big upside, but also the potential of going broke. So, for example, putting all your money into one company, let's say you put all your money into Kodak many years ago, that probably wasn't a shrewd investment. But overall, if we can sort of spread that risk, and that's the way we sort of look at doing this. Spreading that risk, our investment options that we provide you, we like to keep it nice and simple. All right, so with your PSAP, you've got 4 investment choices of which you can play around with or make some decisions around. If you haven't made any investment choices to this point, you will be defaulted into our balanced fund. Now, all super funds are required to provide a fund that has a balanced mix that has some growth characteristics and some defensive characteristics. And if you don't make your own choice, it's required that we put you into this sort of balanced fund. But at CSC and with any super fund, you do have the ability to choose within the investment options in which that super fund offers. And I said, we provide 4 different investment choices. So we've got the 1 cash option, and then the 3 are other pre-mixed managed funds. They're all designed to do different things, and they're all designed for different life stages and have a different level of exposure to market volatility. And when we talk about market volatility, we think about, and at the moment we're in a period of great volatility due to the, what's happening in the Middle East. And how that's impacting businesses. It's not just the price of fuel, but I mean that is the big one. But how that impacts businesses and their ability to be profitable. But we tend to sort of break assets or investment assets into 2 classes, and I call them we call them growth assets and defensive assets. So when we have defensive assets, we're talking about things like cash, and that is a defensive asset. Other fixed interest investments such as bonds, they're designed, and we call them defensive because really it's more about minimizing the chance of a negative return. So the trade-off, and there is always trade-off or opportunity cost in life, and no different in investing. But some investment types are designed to be more focused on, I said, minimizing the downward risk rather than trying to maximize any upward risk. Cash is a really good example of that, and we'll see in some graphs in a moment. The cash rate stays relatively steady. It goes up by 0.25 here and there, but overall, if you have your money in cash, the positive aspect of that is, there's next to zero chance that you will lose any money. In real terms, you might, because if your cash rate that you're earning is less than this inflation cost that for that period of time, in real terms you could be losing money, but ultimately it's a defensive asset. So we focus more on minimizing downward rather than looking at upsides. At the other end, growth assets, think shares, property. They are investments that are really focused for the maximising any potential return. No real maximum when we talk about, particularly with the share markets. Share prices, there's no ceiling, but we certainly can also say that there's no floor either. And in fact, the likelihood of a negative return, the more exposed you are to growth assets. So the more you are, for example, in our aggressive fund versus our income focused, you've got a higher chance of getting a negative return in the aggressive fund than you do in the income focused fund. Now, I say negative return, I'm really sort of now talking about short-term volatility, because the short-term volatility, that is all part of the strategy and the process, and that's what delivers us potentially long-term investment returns. So our aggressive fund, you'll see there, if you can kind of make out the colours, it's predominantly things like shares. Okay, so it's largely weighted towards equities, but it still has a 10% defensive exposure. So there is still a 10% defensive component, and we'll talk about. I've got a graph there in a moment. We'll talk about that, the strategy around that, and how that maybe differs from some other super funds. But ultimately, even though we use the term aggressive, and we have a lot of our exposure to those more volatile markets like the share markets and property markets, we also invest in, while I'm at it, in what we call private equity options. So, businesses or large infrastructure projects that, as individuals, we potentially don't have the ability to purchase, but things like shares, you and I, we could set up a share portfolio. Some of you may already do that, and we could go directly and purchase Telstra shares, ANZ shares, that type of thing. And they're the type of things that super funds are doing. But where we're not probably getting able to do it is some of the private equity investments, such as we're invested heavily in sustainable energy. So we've got some, we own wind farms up in Queensland, and some other examples of that, CDC, and some property, commercial property that aren't really available to individuals to do unless they're billionaires. So but we call it the aggressive fund, but it does still, I think, have a protection against the volatility in twofold, where we've got that 10% defensive makeup of fixed interest and cash, but also, again, within, we talked about diversification, within the share component, that is only really looking at blue chip shares, and that's both in Australia and overseas. So you're spreading the risk there. And then we just look at, say, Australian share markets. We're investing in the top 200 ASX listed companies in Australia. So, yes, there might be some companies that go up and others go down, but we're trying to create a sort of a long-term average. And that aggressive fund will always be designed to do that, and will be more impacted by volatility than, say, the balanced and the income focused, which is predominantly defensive. But even you'll see there is still a large proportion, about 20%, invested in growth assets such as equities, because even when we're sort of focused on income, we still want to get a rate of return that ensures that our balance isn't going backwards in real terms. So again, you as the investor have the choice, or a member has the choice of any one of these four funds, or a blend of a couple. For example, some people might be sitting in balance, thinking I need to have a little bit more exposure to potential returns long term, but the aggressive might be a little bit too strong for me. You could blend that by having half your money in the balance, half your money in the aggressive, for example. Getting too tricky, I've seen people do it where they've sort of blended it up and almost pretty much just designed it to look pretty much like the balance fund, but ultimately you have control over what we do within these four options. So we keep it nice and simple with four options. Some super funds have 10, some have 50, some have more than that. What's right or wrong? All I can say is that the CSC approach keeps it nice and simple, and allows people who aren't necessarily wanting to follow the markets just to know that they've picked their strategy, and they know it's either a long-term or a medium or a short-term investment option. Again, we mentioned the default option is balanced, and most of our employers, due to most of our members, both due to probably the higher contribution rate that the APS gets, but also a strong returns that we do provide, is that we know our members typically on average retire with retirement amount 20% higher than the average. So you're on track there. What's enough for retirement? That's a tricky one. We do some sessions such as planning for retirement and maximising for retirement. If you see those available and you're in sort of wanting to get a bit more of like, how much do I need or how do I plan for retirement? Some of those sessions can be really, really good. And picking your investment strategy around that is an option, but a good starting point is the ASFA retirement standards, and you can see there that, and that's a little bit outdated. It's up a little bit more, but for a single, we talk about 50. I think it's about 54,000 now, and a couple it's around about 77 per annum. So let's move on to market volatility. And I probably jumped a bit quick there, but sometimes I do ask the question, which of those 4 investment choices do you think has been the best option? So I've been very focused on market volatility and kind of the ups and downs. And yes, the aggressive fund does feel the volatility more, which really all that means is that the value of that portfolio will rise and fall more based on its performance. And you can see there that over the long run, so this is going 2017 up to kind of just the start of 2025. I think we're probably due to update this slide, but you can see the patterns that are happening there. That over the long run, the aggressive fund has outperformed the balanced fund, which has outperformed the income-focused fund, which in turn has outperformed the cash fund. And that's all good and well. If you're sitting in 2017 and you have a crystal ball and you knew what was going to happen in the next sort of 8 or 9 years, but we don't. All we know, and if you've ever heard the expression past performance don't indicate future performances, that's true. All we know though is that those 4 lines are doing pretty much what they've been designed to do. Okay, so the aggressive will see more when markets are up, but they'll get impacted. A really good example was when COVID kicked in. This is the first trade war with US and China, but you'll see there that the lines they have a similar look and feel, but the aggressive has been hit more than the balance, which is in turn the income focused. Again, I'll just sort of spoil it. We've got a few slides coming up. What does that mean for me? What does it mean for you? Well, it means different things depending on where we're all at in terms of our retirement planning or our investment time horizon. Because, for example, if we're all in 2017 and none of us wanted to actually access our money well past 2025, then these sort of blips along the way aren't necessarily a negative thing. We sort of think about point A to point B, but if our point B is somewhere where just after a market collapses, then that's where we need to start thinking, what does the future bring? When am I going to want to start accessing this money? Because when we are still contributing and we can't access our super until 60, so if we've still got a long time and to invest, if the markets go down, which they have gone backwards lately, but we're still getting our fortnightly contributions from our employer and any voluntary contributions we're making. When the markets have gone down and we're still buying units in that particular fund, that fund's value has dropped, so we can purchase, but we're still putting the same amount of contributions in. So we're buying more of that fund. So when it does eventually go back up, and we don't know how long it'll take to go back up, but as long as we've got, particularly we talk about an aggressive strategy, maybe 10 years or more, balanced, maybe 7 or 8 years or more, if we've got that time to recover, it's all that volatility actually plays a role. And over the average of what we're sort of doing means that our balance then recovers quicker than otherwise if we weren't contributing. When aren't we contributing? Typically in retirement. So if the market drops and we take money out, that's where the value of our super, that's the impact. That can be a negative impact, because once you've taken it out, you've crystallized any losses or gains. And again, you've got to also remember the long-term gains, but that short-term loss can be crystallized. So that's a different situation. And so that's where your strategy potentially does change, is when and how am I needing to access this money? No questions in the chat. Thank you. Hopefully you are listening though. But it sort of alludes to the fact that our aggressive fund, look, this is a personal opinion, and it's not really important what my personal opinion is, but the term aggressive, I don't think it's necessarily right, because there are a lot of high growth funds, which I think is probably the better category to put it in, where it's all invested in growth assets, and the two main ones, property and shares. All right. But our aggressive fund is only 90%. It still has a 10% exposure to those more defensive, lower yielding but safer type of assets like cash and fixed interest bonds. So what that basically means is when we're in a really strong year, a really good year, typically we'll only sort of capture 90% of that upside. That makes sense, right? Compared to our peers. But where we will see, and this is really important, particularly again, going back to the long-term nature of growth investing, is that downside avoidance is anywhere between 25 and, around about the 25% mark. This one says about 27. It's probably around about the 27 to 25% mark. So over the long run, and that's where when we compare against our peers with particularly long-term investment returns, your CSC funds do stack up. It might just be that when it's a good year, we don't necessarily advertise that we were the top performer, where some funds do. But certainly we could probably expect that we've had a better negative, slightly less negative return than others when there's a bad year, or bad month. So really important to understand that as well. So not only are we diversifying, so spreading the risk by investing across lots of different assets, but we're also sort of this capital preservation strategy, which ensures that, yep, in the really good times we might be missing out a little bit of the party, but when times are tough, we're seeing a bigger upside, which then over the long run sees us as a really strong performing fund. Now, moving on to the next stage, we're going to talk a little bit. I'm just going to use a couple of examples, and we've got Judy and I forget what the next guy's called, Chris, I think. A really important kind of, I guess, example around what you as the individual and your time horizon looks like. So what's your investment time horizon? Again, you might be 55 and you think 60 and you think, well, I've got 5 years of investment. Okay, well, you've got 5 years to retirement potentially, but what happens at 60? I mean, for some people, they take all their super out and they pay off the debt and they've got nothing left, and that would be definitely a 5-year time horizon. But for others, at 60, you're turning that into an income, and you might be drawing out, depending on how much you got in there, 4, 5, 6% of your balance, which means that the other 94, 95, 96% of your balance isn't going to be used that year. It might be used the following year. And you're wanting your superannuation to last, as we said, maybe 30 years, maybe more. You might want to have a chunk of it left behind for your family, your kids, or your estate. So time in the market's really important. But we can sort of use these two case studies as examples, and then each and every one of us is going to be different. But let's look at Judy. All right. So I'm going to take this back to. We sort of on that graph before, we saw that probably the most impactful bit of volatility was COVID, but realistically, and it was a very strange time. I'm sure you remember it, but from an investment markets point of view, the drop off was very, very, very sudden, but it returned pretty quick and relatively quick considering the large sell off that happened. But the last big negative return, long-term impact, was the GFC back in about 2007, 2008. So we're going to use these two examples and kind of highlight the difference that not knowing what the future is going to look like, but what your goals and strategies and times look like versus a short and long term. So let's meet Judy. So we've got 3 years of retirement. We're back in 2007. Okay, so it's July 2007, and her goals are when she gets 3 years, she wants to pay off a mortgage. She's got a nice big chunk of mortgage left over, and then she also wants to buy a caravan. So she's going to need a big chunk of her superannuation at the point at which she retires. So really important to understand that. And of course, depending on what she's invested in, and we think, well, what's the best one to be invested in? So for Judy, looking at if she had 10 or 15 years, the aggressive, yes, the balanced, yes, maybe. But what happened in 2007 was we had an unforeseeable, or maybe it was foreseeable, depending on who asked, we had the GFC and markets crashed heavily. Okay. And as we had in the previous graph where we saw the aggressive outperformed, the balance which outperformed the income focus, which outperformed cash, we can see here when we take a much smaller view that actually the balance was lower. It hadn't recovered as much within 3 years as income focused, and even the cash rate was much better. And we haven't highlighted the aggressive, but the aggressive would have been somewhere down here, so even worse off. So for Judy, she was in a balance fund, and she had $500,000 at this point, and she just stayed in the balance fund. She would have only had, I think, 3 years later, she would have had less money than she started with, so under that 480,000. As opposed to if she at this point had sort of reviewed and decided, look, I'm sort of more concerned about the impact of a negative return because I've got a goal. It's 3 years out. I'm aware that balanced and aggressive investments is more sort of a 7 to 10 year plus investment time horizon. And I'll be more concerned about not being able to pay for my mortgage and not afford the caravan than I am about maybe having a little bit extra, maybe having more than enough. So if she stayed in the balance, she actually would have been, or if she dialed back to income focus, she would have been better off than she had been in the balance. Now, if the GFC didn't happen and the markets went as they more often do, the balance probably would have been outperformed if we had a different section of this kind of the timeline. But we don't know what's coming up next. So really, it's about, for Judy, was she more concerned about, if she's got a goal and she just knows that anything about $500,000 or above would be enough to sort of keep her goals going, then what's the benefit of maybe just eking out a few extra thousands of dollars when really it's about protecting what she's already got? So it's really important to sort of think about where you are, what your goals are, and when you want to access that amount, and when and how you might access it. So in Judy's case, if she decided, look, and going to cash could be probably easier said than done, but maybe at that point, if she'd sat down and went, look, I've got enough. I think I'll have enough, and if it just sort of stays at least where it is, and I keep contributing, I know I'll definitely have enough. Then that's a conversation different to the next person we see where that's not really a concern. But you can see that the impact of not knowing in a short time, it can be sort of that short-term volatility, a negative thing, particularly when you've got short-term goals. As opposed to Archie, sorry, it wasn't Chris, that's the other one. So we've got Archie, and we're going to say it with the same time, back in time at 2007. He was 40 at that point, so Archie's probably looking at retiring very soon. He's more focused on his family. You can see that he's just probably bought a brand new hammock, and he's got at least 20 years until retirement. He's super. So his super is sort of, maybe he's thinking about maybe contributing more. At 40, you start thinking about it, but you start, am I tracking right? Am I got enough contributions going in? Am I investing for long term? But he's more focused on the kids and paying down the mortgage. So it's a completely different story to Judy, where those blips absolutely happened and his fund went backwards. But potentially for Archie's example, going from a balanced fund to an aggressive fund over a 15-year period, which this graph is there, it could for him, or what would have meant, now we don't know, but we do understand over 15 years that we would expect our more high growth funds to outperform, balance, and so on. He's looking at sort of an impact of about $60,000 or $70,000 better off if at that point, 2007, he moved from his balance fund up to an aggressive fund. Yes, the aggressive fund, it took longer to recover. It took about 5 years to recover fully from the GFC. And again, the GFC is quite an extreme example, but really important to understand that that's sort of built into all of the thinking and the strategy. But for him, in that period of time, at no point was he even thinking about accessing that money. His $500,000 that he had at 2007, it didn't represent the finish of the mortgage. It didn't represent a caravan in retirement and traveling around Australia. It was just money that was just going in, and it was still 20 years down the track before he's going to think about it. So in Archie's instance, the market's crashed. Again, he's probably more focused on his family. Hopefully he held on to his job, so he's probably more concerned about that rather than what the balance of his superannuation was or would be. And knowing that it would recover, and it did recover. And in fact, potentially Archie, if he'd come and spoken to CSC and got some good conversation, some general advice, there was some personal advice, It might have seen if you had capacity to put extra in when the markets were down, potentially contributing more, buying more of that discounted units in those funds, he could have ended up having a much better return over the long term. So two different people starting at the same time with two completely different goals and aspirations, and two different strategies that they would take out. So hopefully that's pretty clear on kind of I guess, what's right for who and what have you. Now, again, we're not here to say that you need to switch or need to be aware, but really just sort of looking at kind of what your time horizon is, we talk about that. The other one is, look, if you're personally, concerned about the markets, and if you're in a balanced fund, for example, and you think, look, I just don't want to, I wouldn't want to be more aggressive. It would give me concern, a bit of heartburn, keep me up at night. Then absolutely your individual risk profile tolerance is also an important factor. Okay, so consider that as well. Now, if you're not sure after all this, well, what does that mean for me? One of the exercises I can recommend, and I'm just going to pop this into the chat, if you haven't done this already, is have a go with our CSC risk profiler quiz. It's a really quick one. It's only 5 questions. It's not the most in-depth thing. It is general advice, of course. Still, I suppose it falls in that scope, but it can just ask you a few questions and give you a bit of an idea, a bit of a poke in the right direction around what type of investor you are, and factoring in your time horizon and that type of thing. That could be a really good exercise to do, and something that I recommend. The other one, if off all of that you're still not sure and you just want to have a chat with someone one-on-one, then I highly recommend, if you're a PSAP member, to book in for a consultation with one of our super specialists. Now, our super specialists are financial planners. They're trained and they're licensed to give general advice. And if you're a PSAP member, there's it's a service that's available to you. There's no cost to it. You can use that link that I've popped into the chat, book in a phone-based half-hour appointments, and they can go through and talk to you in a bit more detail around investment strategies and how that might fit in with your current situation. They can also talk about contributions, insurances, anything really to do with your super. If off the back of that you need further advice, there are services that go beyond that. But starting out with a 30-minute phone-based conversation, it can be a really good thing for you. And maybe just a service if you weren't aware of, take advantage of that, and that can help to further any information we've covered off today. So really for you, next steps, we kind of covered both those off. Have a go at that risk profiler. Maybe book in to see a super specialist. Do both. There's no harm in sort of having a further conversation. You've come this far to join this session, and thank you for sticking around, and thank you to DHA for allowing us to present to you. The other one is, if you don't know what you registered, don't know what you're invested in now, log into your navigator. If you haven't done it, register. You'll see that probably you're in that balance fund, but obviously you can change that. You can do that online, and you can switch there anytime you like. So really, that's the bulk of the presentation. If you do use Instagram, you can follow us on CSC_supereducation, where we run some tips and some general information, and also just have a bit of fun with super, which, believe it or not, it can be done. So that's it. I'm happy to stick around for questions, but if you've got better things to do or you want some time back in the diary, thank you for logging in, and enjoy the rest of your afternoon. Thanks, everyone.